Hey everybody, thank you so much for watching and tuning in today. My name is Agabus. This is Financial Education, and today we've got a CNBC article that we're going to run through here and give a little bit of commentary on as well. Today from CNBC, your money. This recession indicator may be a broken odometer for the economy, experts say. Where forecasts stand now. A recent survey of economists, which we'll jump into, shows they are divided as to whether an inverted yield curve, often seen as a recession predictor, points to a downturn. As Wall Street firms reduce their predictions of a chance of recession, here's why forecasts may be different this time. As a reminder, before we get into what the article says, and just as a reminder, an inverted yield curve is in the bond market or the debt market, where a normal yield curve would be seen at the bottom here, where people would invest in shorter duration bonds, shorter debt, to get a little bit lower interest rate, and they are rewarded or they are encouraged to take on more risk for longer term duration for a potential higher return. Now, when it's inverted, as you can see above, you see that the short end of the curve here, this short maturities, are paying significantly more than the longer side of this curve. So the idea being that you are rewarded now to buy or invest in shorter term duration bonds or shorter debt instruments than you are on the longer side. This indicator, generally speaking, is a sign of a recession, but let's go back to the article and see what it has to say. Experts have been pointing to a coming downturn for the U.S. economy. The question is when. However, there are some firms and some experts who are walking back those predictions, calling into question the validity of a once trusted recession indicator known as the yield curve inversion. According to Mervin, an economic policy survey chair at the National Association for Business Economics, he says, while it's true that the yield curve has predicted the past several recessions, in more recent experience, it's been sort of broken odometer for the economy. In the last survey of economists, they found that 2/3 of respondents were at least somewhat confident that the Federal Reserve can help the U.S. economy, while 20% believe the U.S. is either in a recession or will enter one within the year. Going down here, Goldman Sachs recently changed their outlook on a recession and now predicts only a 15% chance of a recession, which was down from 20%. The other big guys in the space, Bank of America and JP Morgan, have also walked back the recession calls as well. The economist that they interviewed has a variety of answers. The biggest one here in blue and black are showing that market expectations of declining inflation or no recession. And then the other one here is a recession is coming within the next 12 to 18 months. So I would argue that the economists seem to be pretty split on what to predict. The article goes on to explain that the yield curve is a graph showing the relationship between yields on fixed income securities, debt, bonds, like we talked about, versus the length of time they have to mature. When the yield curve for U.S. Treasuries slopes upward, with longer-term Treasuries providing higher yields, that's considered normal. The thinking generally is that the longer someone holds the Treasury, you should offer them a higher interest rate because they're giving up their money for a longer period of time. However, when investors think short-term economic prospects are worse than long-term economic prospects, that prompts higher yields on those shorter duration treasuries, which, as we spoke before, is a downward sloping yield curve. The inverted yield curve is often thought to be a recession predictor. The economist says that yield curve inversions have been a pretty good indicator of recessions, but that has not always been the case. While the yield curve inverted in 2019, that was not necessarily a predictor of the 2020 recession. I would argue the 2020 recession was due to a response of COVID and not necessarily a normal, quote unquote, normal recession. The article concludes that the economists are mixed, as we discussed. Some saying that maybe this time is different. Well, maybe this time is different. But there are reasons why it's usually a predictor of a recession coming in. And finally, the article says, recession or not, experts' advice to prepare for a downturn still holds true. Please set aside some cash, emergencies to weather any unfortunate, unforeseen events or emergencies. We shall see if the indicator holds true this time around. The last couple times the inversion took place, there is a little bit of a lag effect. So whether it's tomorrow, next week, next month, or next year, boy, it's anybody's guess. But we shall find out. Thank you so much for listening. Thank you so much for watching. In today's free content on YouTube, the currency nowadays is the like button and subscribe. So make sure to hit the like button and subscribe for more content so I can make sure to bring this out to you daily. Stay curious, stay interested, stay informed. We'll see you next time.